Hi, my name's Christine Atencia and I'm a Senior Financial Advisor at Nexia, Sydney. Welcome to my video blog series on financial planning for families. In this week's vlog, I'm going to be talking about how to build wealth for your family. And before I get into the technical side of some tips on how to go about doing this, I actually wanted to take a step back because I really think that it's important to firstly understand your why. Why are you making the decision to build wealth for your family? So the most common whys that I get when I discuss these sorts of things are, for example, time freedom. They want to provide their kids with the best possible education. Another example is they want to generate passive income so that they can retire early. For me personally, some of my whys are creating memories with my family through travel, whilst also adding, say, a charitable stint to each holiday. Another thing is teaching and educating my children about the importance of finances and really understanding the value of money. So as a starting point, have a consideration for your why. The second step of, developing a wealth accumulation plan is having a think about which vehicle is best suited to take you to that ultimate destination. And when I talk about vehicles, I'm referring to what sort of entities might be most appropriate for you to invest in. For example, I guess the most common one would be to invest in your own name, or perhaps you could invest in joint names with you and your partner. Other options to consider might be a family trust, a company, your superannuation fund, or an investment bond. And each of these vehicles have their pros and cons. You could even have a combination of some of them. It's just really a matter of working through the pros and cons of each, looking at issues like taxation, accessibility, whether or not it's flexible enough to provide you with a cash flow if you need it, and also, cost, and asset protection and estate planning. So for example, most people have a superannuation fund. It is a very tax effective vehicle. However, the key downside of that is that you can't access it until you retire. So finding the balancing act between which entities would be most appropriate for you generally does require some sort of taxation advice as well as financial advice. Once you've established which vehicle or combination of vehicles is most appropriate for your own situation, the next stage is to ensure that you've got enough fuel in the tank to get you there. And essentially what I mean by this is your investment strategy. So it's really about identifying which asset mix is most appropriate that meets your risk profile, your return, and your time frame requirements. And I suppose you can consider how much to put aside in your defensive assets like cash, term deposits, bonds, or perhaps even an allocation to your offset account if you've got a home loan for those ad hoc capital expenses as well as emergency funds. So ad hoc expenses like renovations and provision for holidays. And then I guess the next step from there is to work out for your long-term investment strategy, what are you going to invest in? Whether it's Australian or international shares or property, for example. So finding these combinations of issues to consider as part of your overall wealth accumulation plan can be pretty complex when you're talking about the right vehicle as well as what sort of investments to go into. So I do strongly encourage you to seek financial advice, and if you have any questions, feel free to reach out to me. But other than that, I hope you enjoyed this vlog, and I look forward to you tuning into the next one.